This is Chapter 12, Video 2. Let's launch. Okay, everybody, so welcome back to class. So basically what we're going to do is we're going to talk about equity-based compensation. None of this is going to be on the exam. If you want to go ahead and shut off the video at this point, you can. I've had some students who have actually asked about this topic before, mostly, and it's not so much because they feel, oh gosh, I'm going to go out there and make a whole bunch of stock options. Guys, most of the time in the CPA world, you're not going to earn these kinds of things unless you end up working in financial accounting. And say, for example, you end up being the officer at a corporation or at the company. Generally speaking, when you're talking about stock option incentives as personal compensation, that's when you're going to see it. Of course, most accounting firms are not organized as corporations, and even if they are, they're definitely not publicly traded corporations. So that's something that needs to be taken into consideration here. And so I'm going to talk a little bit about some of the different types of equity-based compensation. If you do personal tax returns, you will run into some of these every now and then, and so it's kind of good to know from the personal side, but then also on the business side, hey, if we offer these things, what do we need to do? So, looking at the first one, what you're going to see there is that you've got the incentive stock options, which provides favorable tax treatment to employees. So, for example, if I give you incentive stock options, what's really good about this is that they're really not, there's a lot of, they're not really taxable to the individual until they are like exercised, which is awesome because, you can do that sort of thing, and it actually does a lot of really good tax benefits to the individuals. I remember several years ago when I was working in an accounting firm, we had a client who actually got a whole bunch of these. And they're nasty in terms of the AMT effects of it. At least it was back then. Now that AMT has pretty much been moved to the fact that it really doesn't go to anybody other than the super rich, for the most part, I see that instead of stock options could end up making a return. I haven't seen a whole lot of it, but I'm kind of surprised that we haven't seen as much as I would expect. But because of the AMT effects being gone, they're not as bad as they were, say, about 10 years ago. Then you have non-qualified stock options. So these are ones that don't meet the qualifications for being classified as incentive stock options. These ones you will have, there is actually going to be an ordinary income tax effect that does happen as a result of this. And we'll kind of talk about this after we get past some of these definitions. And so you have the grant date, which is the date on which the employees are actually given their stock options, but they can't sell them at that point because they haven't earned them yet. So if I go ahead and I say I'm going to pay you stock options in order to work at my company, and I grant you these options, you have to work for a certain amount of time in order to get those options. If you don't finish the 3 years, you don't get the options. That's kind of the way that it ends up happening. And then you have the exercise date, which is the date that employees purchase the stock using their options. So on the date you can actually purchase it. And of course the exercise date is the date when you're actually going to be doing it. The vesting date is when it's going to be allowable to you. So that's actually, again, this is just the date where you actually exercise it, and then of course the exercise price, which is going to be based on whatever you end up paying for it. Okay, so there's going to be a bargain element, which is the difference between fair market value of the stock and the exercise price on the exercise date. Now that doesn't, so for example, if you are granted the shares at say $6, and 3 years later that $6 now is $13, the bargain element on that is going to be $7. Okay, per share, and that's actually pretty good. Now there's two different types of bargain that you're going to have to deal with in this. You could have it to where it's bargain at the time of exercise, or you can have it to where there's a portion where you end up. So say for example, fair market value at grant date is $6 a share, and I give it to you, and I say, look, I'm going to give this to you, and I'm going to give it to you at $4 a share. you are actually introducing a level of taxation to that individual that's going to be pretty bad. Not as bad as the fact that you're actually getting a $2 break off of it, but again, it is something that that could have some other effects that you may not be aware of. So the vesting time is the time when between grant and exercise. So you have the date that's granted, then you have a 3-year vesting period. At the end of that 3-year vesting period, you can exercise. Again, you're going to have the grant date, the vest date, and then the exercise date. Okay, so the tax considerations. So when exercising in QOs, the employee will report ordinary income equal to the total bargain element on the shares of the stock acquired. So, for example, if I give it to you, So for example, if I give it to you on, usually what will end up happening is they're going to give you the options at grant at the fair market value at the date of grant. So say it's $6 again, and it goes up to $13. You're going to have to recognize ordinary income on that $7 per share. Now, what does that mean? That means they have to withhold taxes from you on that. And we'll talk a little bit about that later on. Not just income taxes, but also social taxes. So you could have a situation where, you're withholding, and we'll get into the reasons why. You're going to withhold 22% on the federal income tax level. You do have to withhold at 7.65% for the Medicare and Social Security. So there's a lot of stuff that ends up happening. So even though you go to these people, you say there's 1,000 shares, it's at $13, you're thinking $13,000, and the person only ends up getting, just shy of 10, and they're like, what's going on? Well, we had to withhold taxes. Okay, so that's generally something that happens. Okay. So the basis of the NOQOs is going to be NQOs is going to be the acquired at fair market value on the date of exercise. So the way the IRS looks at this, we granted this to you at $6 a share. You have paid taxes on the $7 difference. That $7 difference is going to increase your basis in that stock by that $7. And so that actually is a good thing for you, because if, say for example, you've got your grant date, your vest date, and say you decide that you're going to wait 6 months before you actually, say you work in an industry where, like the first 2 months of the year or 3 months of the year might be really busy to you. You don't have enough time to get to the stockbroker and say, look, I want you to sell these shares. So you wait a few months in order to get it. The difference between the vesting date and the actual date of exercise is going to be considered a capital gain loss period of time. You also have the basis, also includes exercise price plus the ordinary income that the taxpayer recognizes on the bargain element. So that's important. Incentive stock options based on the shares acquired is the exercise price. Holding period for the stock acquired with NQOs and ISOs begins on the exercise date. So once I exercise and I purchase them, if I want to get long-term capital gain treatment off of it, I have to wait a year after that. Okay, and that's important to know, because oftentimes what happens is most people are like, okay, I'm going to do this, and I'm going to execute, and I'm going to get my money immediately. Well, if there's any difference between the vesting date and the exercise date in terms of price, that's going to be short-term capital gains or losses to that individual. I actually had one person, it was just this year, they exercised some stock options, ended up losing money because it was during March. So I feel bad for him, but at the same time, he didn't wait. He didn't exercise fast enough, evidently. So for either type of options, employee experience no tax consequences on the grant date or vesting date. That is true. You will pay absolutely no taxes on grant or vest. Okay, it's not until you exercise. And part of the reason why is because the IRS looks at it, you don't have any cash. So as a result of that, it doesn't make any sense to tax you at that point. Again, any further appreciation or depreciation of the stock will be treated as either short-term capital gains or losses, or long-term depending upon the exercise date. All right, employer considerations. So now flip on the other side and say now you're the employer. What are going to be some of the tax consequences of this? You have no tax consequences on grant date. On exercise date, bargain element is treated as ordinary income to the employee. Employee will hold the stock with a holding period beginning on the date of exercise, and employers deduct bargain element as compensation. What that means is if I give my employees a bargain element on this, that is compensation I get to take on my tax return. Okay, and if you think about it, it's the great balance sheet. If the employee is going to recognize an ordinary income item as a result of this, then the employer is going to have a corresponding write-off that's going to have to happen too. Okay, so for incentive stock options, there's no tax consequences on grant date or an exercise date. Yeah, so if the holding requirement are not met, option becomes treated as NQO. This is huge. If you find out one of your clients has these ISOs, you need to be all over this. You need to be all over this because in order for them to get long-term capital gain treatment, they have to wait a year. If they don't, they're going to get treated just like an NQO. All right. So if there's no deduction for employer unless employee doesn't meet holding requirements. So there's an employer incentive for them not to meet the requirements. Again, generally speaking, you don't give these to people that you just want to give shares out to. You're going to give the ISOs out to the big guys, okay, and big guys and gals, I should say, just so I don't misgenderize anybody. But you are going to hand this out to the bigwigs. Because this is going to be very, very favorable tax treatment to your bigwigs, and at the same time, they're getting compensation for stuff for sticking with the company long enough. So employers don't usually they don't see it as ISOs being favorable because they don't provide them with the same tax benefits, no deduction, and there is an IRS regulatory requirement. But again, like I said, if you've got a bigwig that you really want to take care of and you want to hand them some type of compensation, bada bing, bada boom. This is a great way. And especially this actually can help you. Say, for example, you have an employee who makes $1 million or close to $1 million and you want to give them additional income. ISOs is a different way that you can do this while compensating the employee. Yeah, I don't get a tax deduction for it, but it's good for them in the long run anyways. Okay, so firms with high marginal tax rates may lose significant tax benefits by issuing ISOs. This isn't a big issue because right now we have a flat rate of 21%. Not a big deal. In fact, that's another reason why I'm kind of surprised that we haven't seen the increase in the use of ISOs is because right now it's a great time to do this. So on the other hand, startup companies or firms with net operating losses may actually benefit by issuing ISOs. And I would agree with that because if you have net operating losses, you're probably not looking for additional losses anyways. ISOs would be a great way to go if that's the case. For tax purposes, your employer is going to deduct the bargain element as an exercise price. For GAAP purposes, employer expenses the estimated value of the option pro rata over the vesting period. And that's because, again, it gets back to that principle of matching that we have, which says I'm going to match the expense with the time period that it's actually accrued. And this is actually, this talks a little bit about this. Is actually an example from a question that I'm going to go ahead and skip. Okay, restricted stock. Actually, I would say this is probably the most common thing that you're going to run into is RSUs. Okay, so restricted stock, it can't be sold or otherwise treated as owned by the employees until the employees have the legal right to sell the shares at vesting. Okay, employees receive the restricted stock on the vesting date without having to pay for it, after which they can either sell it immediately or retain it. Okay, so and then the tax considerations, RSU is treated as it's taxed at the fair market value of the shares at the date that it vests. So what'll happen is you're going to be like, I'm going to give you some RSUs. I don't care what the fair market value is as of today. Doesn't matter to me because what's going to happen is the RSUs, you're going to have full inclusion in your W-2 wages at fair market value once the stock vests. All that you care about as the employee, how long is it going to take me before I get my money? Okay, that's all I care about. When am I getting my money? Again, we're like J.G. Wentworth. It's my money. I want it now. Okay, so that's something that ends up happening with this. Yeah. Now this, I want to talk a little bit about the 83B election. This is what we sometimes call the gambler's election. What ends up happening is that, say, for example, you're going to get some RSUs and you know that the RSUs, this company is going to go through some really good growth and you're very confident that it's going to do that. It is a good tax strategy that if you say, look, I know it's going to go through some really good growth, they're going to give me, say, $250,000 worth of RSUs, or what I expect to be around $250,000 worth of RSUs. And so I say, look, I don't want to have ordinary income over that time period and say it's like 1 or 2 years. I want capital gain treatment. Now, of course, if you're talking $250,000, person probably making $400,000, maybe they're at max tax gain rates anyways. So they're at 37%. If I can take you from 37 to 20%, that's a 17% savings on your tax rates. That's huge. Okay. So you can do what's called an 83B election. So there's no tax consequences on grant date if you don't have the election. Employer recognizes ordinary income on the value of the stock at vesting date. Holding period of stock begins on vesting date. Employer deduction value begins on vesting date. Okay. With an 83B election, the employee will recognize market value of the stock as ordinary income. So if I'm going to be given a ton of shares, we'll say 100,000 shares, and they're worth $1 a piece, and I expect that they're going to go from $1 a piece to $5 a piece over a 5-year period. Very likely, because we've got some really innovative products that are coming out. Think it's going to really launch off. It's really good. So you're giving me 100,000. What happens is I do an 83B election. I'm going to recognize $100,000 of income today. Now, do I like paying taxes on $100,000 of income today? No, but I'm going to, because this is going to be a good deal for me in the long run. Okay. The employee then takes fair market value of the basis in stock at the date of grant. Holding period begins on grant date. You've already paid taxes on this. As far as they're concerned, you are at the holding date. So if the stock never vests, however, this is where the gambler provision comes in. If the stock never vests, no deduction for basis in stock. In other words, you can't claim a loss. Okay. The employer will deduct the value of the stock on grant date if they know that there's an 83B election. And that's why if you do one of these, you want to make sure that the employer knows about it so they can take the deduction. Because they can take it on the grant date instead of the vesting date. I'll be honest, the only 2 or 3 times we've actually looked at this, we're talking about people who have more than $1 million in compensation, and they're looking at potentially receiving stock that's $1 million to $2 million. I think we had one that was looking at possibly around a $4 million possible gain. So we looked at doing the 83B election just so that we could take the hit now, but massive tax savings over the long run. That's kind of what we wanted to do. So employer considerations for restricted stock, the timing of the deduction depends on the employee's decision. As an employer, you have no decision in this. You have skin in the game, but no decision. It's really up to the employee. And that's one reason why a lot of these, especially if it's really, really worth it to the individual, probably not going to worry about it until unless they're kind of bigwigs, because that could have a major effect on the company's bottom line. For other issues, for tax, the employer does get to deduct the market value when the employee recognizes the income. For GAAP purposes, you're going to deduct the grant date value over the vesting period, and that's how you're going to end up doing it. Okay. And I remember when this used to be a big topic, and now it's kind of gotten done. This is actually a good. I actually recommend looking at this because they have the RSUs versus the ISOs versus the NQOs. I'll tell you what, if you get into individualized tax, you might want to make sure that you have a copy of this, because when I first got into this and I started doing stock option tax accounting, it was confusing as hell for me. But I think this is a way that you can actually bring that down and make things work out all right. Okay, guys, so that's the end of class. I hope you guys learned a lot. Like I said, none of this is going to be on the exam. I just think that this is a little bit too much to put on to an exam, but I think it's very useful because I do get a lot of students who say, hey, I'd like to learn a little bit more about this, and it is valuable. But if you have any questions, feel free to reach out to me, and I look forward to seeing you guys in class.